Hey, what's up, guys? It's T.Mayne here, your FX Chasers mentor, back again. Lovely to have you guys here with us on this YouTube video. Now, as Funny Lucky has already given you guys the hint, we're going to be going into some entries and as well as some candlestick confirmations. Now, to kick things off, guys, without any further waste of time, I want to discuss with you guys the two types of entries that exist within Forex. Now, we'll look at two case scenarios, one of a reversal structure, which we'll just use a double top for simple explanation purposes. And then the second will be a continuation structure, which we'll use, let's just say, a bearish flag, just so we have both of these markets moving in the same direction. And I'm going to explain to you guys the two types of entries that exist. Now, the first type of entry is called a risk entry. Now, someone would ask, what is a risk entry and why is it even called a risk entry? So what a risk entry would be is an entry that presents itself before price action has impulsed and broken structure in the direction that we are looking to trade. Now, guys, I love to simplify things to make it as simple as possible for you guys to understand. And yeah, I also like to explain the why. Like, we know that this works and that works, but I think it's so valuable to explain to you guys the why behind these things. Now, like I was saying, a risk entry is an entry that presents itself before the market has impulsed and broken structure in the direction that we're looking to trade. If we look at this example here of our double top structure, what we will see is that this market first pushed up, created one peak, pushed down, created a neckline, pushed up, created a peak, and then violated structure, came back to retest, and then continued to the downside. Now, if we look at the individual structures or legs that are within this larger overall double top structure, what we can see is that market first of all created a peak, pushed away, came back, and is now retesting this previous resistance area. Now, if we got an entry in this area here, that would be considered a risk entry because the market has not impulsed and broken structure in the direction that we are looking to trade. Now, obviously, a reduced risk entry would be an entry that presents itself after the market has impulsed and broken structure in the direction that we're looking to trade. So for example, in this case, we have the neckline. We can see that prices have violated this neckline to the downside and then have actually come back to retest this neckline here, and then we see some continuation. So any entry that would present itself in this area here would be considered a reduced risk entry. Why? Because the market has impulsed and broken structure in the direction that we are looking to trade. Now, we'll look at this next example here of this bearish flag, and I'm going to show you guys what a risk entry would look like on a bearish flag and what a reduced risk entry would look like. So bearish flag, we normally would look to be trading that third touch over there, or I guess the second violation of a higher structure, first violation, second violation right there. So we'll be looking to take a trade within these areas here. Any trade that we take from that area over here would be considered a risk entry. Why? Because the market, if we look at, or if we isolate the structure over here, the market has not impulsed and broken structure in the direction that we are looking to trade. Now, obviously, if we got some sort of a break, or if you're trading the breakout of this bearish flag, any entry that presents itself after this market has impulsed in our direction and then violated structure will be considered a reduced risk entry, because now we have the added confluence of price breaking levels of structure in the direction which is to the downside that we are looking to trade. Now, let's get into some candlestick confirmations, guys. Now, remember, I told you guys that there's two types of entries: risk entry, reduced risk entry. Obviously, a risk entry, guys, will give us more of an opportunity if we manage to get an entry up here, stop loss above our structural highs, and then obviously take profits wherever based off structure. If we take these risk entries, guys, these risk entries obviously give us an opportunity to capitalize more on a better risk to reward ratio, and as well as an opportunity to be able to further scale in on our winning trades. Like, for example, if we manage to take a risk entry on this bearish flag, we could additionally also take a reduced risk entry after price has broken, obviously managing this trade in the appropriate way, stops above structure, all that nice good stuff. And then, guys, giving ourselves an opportunity to capitalize even more on the same downward move that we're expecting. So a risk entry, like I was just mentioning, obviously gives us a better risk to reward ratio and an opportunity to capitalize and maximize on our winning trades. Now, in addition to that, a risk entry is also more of a risk to take. You face a higher chance of you being stopped out of the market taking a risk entry than you do taking a reduced risk entry. So can you see the difference between the two? A risk entry is a lot more unsafe, but you can get more risk to reward ratio, and I guess there's more benefits in taking a risk entry in terms of reward. And then a reduced risk entry, you have more guarantee that prices are not going to be stopping you out as often, but at the same time you are sacrificing the amount of risk to reward that you can maximize on this same position. Now, to get into our candlestick confirmations, guys, and I guess everyone's been waiting for these candlestick confirmations. So for candlestick confirmations, guys, there's a song that I love to sing, and I'm sure the guys in the 3.0 course already know the song, that when we are taking a trade and we're looking for candlestick confirmations, first, the market must create a level of structure, push away from this level of structure that we've created, come back to this level of structure, and then show us two things. What are the two things that we need to see? First of all, we need to see a rejection from this previous resistance area, either in the form of, I don't know, a lot of things can give this rejection, but most commonly you'll see those bearish pin bars, or those candles with a bigger wick than a body to the upside, obviously bigger wick to the upside than the body. That shows us a rejection from a level. Why do we wait to see a rejection first from a level? Because we want to see price respecting previous support now as resistance. So we first wait to see the rejection. The rejection shows us that there is a reaction happening from this area where we expect the market to react. So that's the first thing that we look for. The second thing we look for is a momentum shift. What is a momentum shift? Confirmation that sellers are present, that sellers are in the market. What kind of a candlestick will give us or show us that confirmation, that momentum shift? If we see a bearish engulfing candlestick, so obviously a candlestick that has a lower low and a lower close than the previous green candlestick, or maybe even a red candlestick, could even be a red candlestick, still a bearish engulfing candlestick. So guys, that is basically what we look for. First, we look for a rejection of the area, then we look for a momentum shift. Now, I was telling someone in our live session yesterday that depending on the time frame that we see this pin bar, I will be willing to take this pin bar as my confirmation. Because what is a pin bar? A pin bar is, or how a pin bar forms, is when prices open at a level. We say prices open here, and then prices make a move to the upside, and then prices reject, push lower than they opened, and then prices close lower. So that is a bearish pin bar. If we take the open of this, the close of this, and obviously we draw our body of our candlestick, and then we draw the wick to denote the high of our candlestick, then we can see that this is a pin bar. Now, bearish engulfing candlestick is the exact same thing, guys. We have a green candlestick that pushes to the upside, and then a red candlestick that opens and then closes below the previous green candlestick. If we take the open of the candlestick, the close of the candlestick, and the highs that we have there, you can see how a bearish engulfing candlestick is the exact same thing as a bearish pin bar. Now, depending, like I was saying, depending on the time frame, guys, the higher the time frame we find these candlestick confirmations, the more valuable they are to us as traders. If we find a pin bar on the H4 candlestick, I'll be happy to take a pin bar as a entry confirmation. But if I was on a lower time frame, for example the 15-minute, then I would wait for a pin bar to form first, followed by my momentum shift, form of a bearish engulfing candlestick. So the lower the time frames I'm looking at, the more I want to see both of these happening. The higher the time frame I'm looking at, the more I'm willing to trade just a simple bearish engulfing or just a simple bearish pin bar. Now, those are the two major, or the two most important, I guess, candlestick confirmations that we look at. Now, I have a live example just to show you guys the charts. I know I picked a lot of very specific, nice, beautiful textbook examples, but we know that the market is not always so straightforward. So it's important for us to actually have a look at the market and see these things obviously happening in live market situations. So if we look at this, we can already see this head and shoulder structure that has broken down. So guys, if we were taking an entry, obviously from the right shoulder, that would be considered a risk entry because price has not violated structure in the direction that we're looking to trade. So guys, all I would be waiting for, like I was saying, is a pin bar to the upside followed by a bearish engulfing candlestick, and that would be my entry. Pretty much straight and forward. Now, that's not to say we never lose with these entry criteria, because remember guys, we are trading and we are trading based off probabilities. Now, we don't understand how those probabilities are going to play themselves out, but we know that if we execute one system continuously, we will make money in the long term. Now, I also just for you guys denoted an example of a reduced risk entry, which is obviously an entry that happens after prices have basically broken structure to the downside. We can see there we violated impulse in our direction that we're looking to trade because we're looking to sell, because we have a head and shoulder structure, and prices have basically retested some necklines over there, and then they've given us that pin bar followed by our momentum shift in the form of a bearish engulfing candlestick. All we do is we take the confirmation that we do see over there with our bearish engulfing candlestick, and our pin bars obviously stops above levels of structure, and then we'll target the exact same area. Notice how we have a smaller risk to reward ratio, but obviously if we refined our position on those smaller time frames, we would have a risk to reward ratio that would have been a lot better. So all we do from there is we basically just let the market play out, let the probabilities play out, and then we see what the outcome of our position is. Let's just play this out, see if we hit TP. Almost hit stops there. Wow, that was close. Let's just play this out, guys. I'm also excited to see how this goes, because I just randomly looked for a head and shoulder structure. The moment I saw one, pressed bar replay, make sure that we go back without really seeing and being biased when we are looking or when we are doing these types of I guess videos. So let's see, hopefully we close to TP. Oh, beautiful. Nice. And we even follow through even lower, guys. So anyway, this is basically the two types of entries that we have. We have, like I was saying, just a quick recap for you guys. We have a risk entry, which is an entry that presents itself before the market has impulsed in our direction and broken structure. And then we have a reduced risk entry, which is an entry that presents itself after the market has impulsed in our direction and then obviously violated structure to the downside, because we're looking to trade to the downside as well. And the confirmations that we look for, all we're looking for is a rejection from a level of structure that the market has created itself, followed by a momentum shift in the form of some sort of bearish engulfing candlestick. Guys, it's that simple. There's really no magic to trading. Trading is just a game that is built on psychology and risk management, and if you can master those two with addition to mastering your methods of execution and obviously the systems that you have in place to be able to manage your positions while they're open and all that other extra stuff, guys, you will be a consistently profitable trader. It's just a matter of time. It just requires you to refine the entries, to refine the systems that you've developed for yourself. And once you're used to the systems and you start to execute these systems automatically, that's when you'll be able to start letting the probabilities play out. When we open a position, we have no idea whether that position is going to be a winner or a loser. But we understand the probabilities that we win more often than we lose. And also we understand our risk to reward ratio, that even if we lose 7 out of 10 trades with a good risk to reward ratio of 1:3, we can still only win 3 out of 10 trades and still be profitable traders. Guys, that is the power of actually waiting for these entries to actually present themselves. Understand the type of entry that you're taking and obviously the associated risk. Understand the type of candlestick confirmations that you're trading and obviously the probabilities that are involved with those candlesticks following through. Guys, this is T.Mayne, your FX Chasers mentor. I'm so glad that you stayed until the end of the video. Obviously, guys, once again, drop this video a like if you have gained some sort of value. Let us know that we are giving you guys what you guys are looking for. And as well as if it's your first time on the channel, definitely do subscribe. And the family that's always here, guys, we appreciate you guys. We're doing this just for you. Love, peace and happiness, guys. I'll see you in the next future video, guys. Cheers.